What's up, guys? Hope everyone is well. Today I'm going to be doing a quick explanation slash presentation on options trading for beginners. Basically what exactly options trading is and what is included in it. I know if you're starting out trading, I know for a fact learning options trading is very difficult. There are so many different terms, so many different things that you kind of have to plug in to really fully understand it. And with all of these YouTube videos, it gets pretty difficult to actually understand what it is because everyone is explaining in such large, unnecessary terms. So I'm going to make a quick, easy video explaining options trading, what is included in options trading, what you need to know, and how you can actually get started. I'm going to be doing multiple different parts of this type of video, so stay tuned and let's go ahead and hop right in. So for options trading, just going to boom, options trading. Boom. Now, inside options trading, it's actually pretty cool because you can make money when the stock also moves down, right? I'm sure you're mainly familiar with making money when a stock goes up, but you can also make money when a stock goes down, and that's called a put, right? There's going to be two main option contracts that you're going to want to focus on, and that's going to be a call and a put. Now I'm also going to write down call right here. Now, as I just mentioned, we buy a put contract when we think the stock is going to go down or when we are bearish. So put, just going to put an arrow to the downside, and I'm sure you can already guess what the call is going to be. We're going to buy a call when we are bullish on the stock or when we think the stock is going to obviously move to the upside. Now, with options, it's also pretty difficult and different from regular trading due to the fact that there are multiple different option contracts that you can buy at all times, right? It's not just one price. So let's say, for example, we're trading Tesla, and I have no idea what Tesla is currently at, but let's just say it's at $500, right? So let's say Tesla is at $500. Now, another cool thing about trading options is you do not need exactly $500 to trade Tesla. What you can do is you can buy, let's say, either a call contract for boom, 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 for 0.50. Now, the reason that I wrote, let me go ahead. The reason that I wrote 0.50 is because every option contract that you are buying is multiplied by 100 shares. So this 50 cents, that's not the total cost of our contract, of our option contract. Since every option contract has 100 shares, 100 shares multiplied by the option price, we want to times this by 100, and our total cost of the option contract will be $50, right, for a call. So if we are bullish on the stock, we think price is going to go up, our technical analysis shows us that price is likely to go up, we buy a call contract, right? Because that's the option that we buy when we are bullish. Now, like I showed you guys, we have the 50-cent option contract times 100 shares, which turned out to be $50. Now, let's say Tesla starts to move up. So now that the Tesla stock is at 500, let's say that it starts moving up to 501, 502, etc. This $50, as Tesla is moving up, this option contract, which is $50, gets more valuable, aka that $50 turns into 51, 52, 53, 54, etc. as Tesla continues to move up. Then, when we are ready to exit our option contract, If that option contract gained value, meaning our technical analysis or our fundamental analysis was done correctly, we will sell that option contract, which then, let's say Tesla turned into 501, which is just about a dollar move. Now, all option contracts are going to move differently, but let's say that $50 then turned into 75. You sold 75, so now you have $25 profit on that option contract, right? Due to the fact that since Tesla moved up while you were holding that option contract, the option contract gained value. Meaning when you sold, you profited the value and you also still had the capital in which you bought at, the $50, then that turned into $75. So you close out at the 75, obviously meaning it's $25 profit. Now, let's say you bought more than one option contract, right? Say, pretend, kind of relate it to when you're trading shares. When you're trading shares, you can buy more than one share. Now, let's say we only bought one option contract here at $50. Let's say we times that $50 times 2, and then that would turn into $100, right? Because we bought two option contracts at $50, so that $50 times 2 would turn into 100, and then obviously if we caught the same exact move, which would have been that $25 profit, we don't have only $25 profit. We times that $25 profit times 2, since we bought two option contracts, which then turns into $50 profit. This 50 was pretty ugly. Don't mind that. So that's kind of how buying option contracts would work. Now, when buying option contracts, there are two things that I didn't mention. I know this is a mess. I wanted to explain it as best as possible. So let me get rid of all this. Okay. Boom. Let me dry this off. Now, the two things that I didn't mention is that we're going to have, for every option contract, we're going to have what's called a strike price, which I will write up here actually. We'll have a strike price. Now, what is a strike price, you may ask? The strike price is the price that the trader is going to buy in at. So, as I mentioned earlier, there are multiple different contracts that you can buy in at. And since there are multiple different contracts, that means that they are all going to be priced differently, right? So, we have our strike price. So let's say, like I just mentioned, Tesla is at $500. So for our strike prices, meaning the option contracts, the option contracts and strike prices are pretty much the same when I mention that. So the strike price, which we have Tesla at 500, our strike prices would range around 499, 500, 501, sometimes 501.50. So sometimes the prices will differ depending on what stock that you are trading. So we have the strike prices. And as we have different strike prices, obviously the strike prices cost different actual prices, right? Now, think of this is not the actual price of what you're paying for your contract. This is the price that you're buying in, which is nearest to the stock that you are trading. So say that you are bullish on Tesla, right? Which is at $500. You would buy a Tesla call at either 501, 502, etc. Or you can even buy the 500 call, right? So those would be the strike prices. Now, as I showed you guys, we have different strike prices here. Let's say that the 499 would cost about 0.30. And then right here, 500 would cost 0.60. And then as the strike prices go up, the actual price of what the contract would cost you to trade it goes up as well. So 0.60 and then 0.75 and then etc. We have, let's just say $1. But when I say 0.30, 0.60, 0.75, the cents, like I mentioned earlier, that's not what our full price of what the option contract is. We always want to times that by 100. So if we are buying, let's say the strike price right here, which we have, let's say we're buying the strike price at 501. So strike price at 501, go ahead, boom, boom, boom. 501, and then we are buying equals 0.75. Now, 0.75, we always want to times the option contract price times 100 equals $75. Right? So now we know that our option contract cost $75. Obviously, if we were to buy multiple option contracts, right, not just one, we would times that 75 times whatever the amount of contracts that we would be buying. Now, as our strike price is 501, right, Tesla is 500. So as I showed you guys earlier, obviously, if Tesla moved to a higher price, let's say it only moved to about 550. It's getting a little messy, but I'll fix it in a second. Let's say it moved to 550. Now, since the option contract gained value, this $75 would then turn into, let's say, $90 or 0.90, right? And then of course we times that by 100, which would be $90 is the cost of our option contract now that price moved in our desired direction. And then obviously we have 90, 75, boom, and then that's $15 profit, right? So $25 profit. I'm thinking and talking too much. So same thing, $25 profit, and then obviously you would times that by whatever the amount of contracts that you would buy if you obviously did buy an extended amount. So that's the strike price. Now, the last thing that I want to go over let me go ahead and erase everything. Sorry, give me 1 second. Okay. So, main things included in options are going to be our call. Oh, wow, hold on. Our call, which we buy, This is really bothering me. I'm sorry. I don't want my letters to look ugly. So we have our calls and we buy a call when bullish. Buy when bullish. And then you already guessed it. We have our puts. And then I'm just going to put buy when bearish. I'm just going to put a down arrow. I'll put an up arrow here. Boom, boom for bullish. And then we also have our strike price. Boom. Strike price. And that's obviously going to be the prices that are nearest to the stock that we're trading. So as I mentioned earlier, let's just say that we have, Nvidia at like 900. Our strike prices would be 900, 901, and you guys get the point, etc. You keep moving up. That would be our strike price. We obviously have our prices of what the option contract would cost. So I'm going to go ahead and put price right here, and then let's just say obviously an option contract would be $1.25, right? A little bit more of a more expensive option contract. Now, this option contract does not cost us $1.25 to buy it. We obviously want to times that by 100, right? Every option contract by 100, which is 125. The price of what one option contract would be to buy, $125. And then obviously, let's say that this was a put, right? We haven't done much examples of puts. Let's say that we bought the strike price at like 900. Boom, boom. Now let's say if we bought a put, that 900 turned into 897. That $125, since it was a bit of a larger move, that could turn into, let's say, like $200, right? And then you do the math on that, and then obviously you get your profit. But let's say if it happens to be a loss, right? Let's say that your fundamental or technical analysis isn't done correctly. Let's say that you buy an option contract at, you buy the strike price 901. So let's say that you're buying this 901 strike price at 0.90, which would obviously equal out to $90 for the option contract. So let's say you bought a 901 call. Now let's say that 901 absolutely dumped and turned into 899, right? A couple dollars move to your non-desired direction. This option contract would obviously lose value, meaning it would turn into, rather than $90, it would turn into $85, $80, and it would keep going down as the stock that you're trading goes down, right? And that's also why it's very important to have a stop loss and always have strict risk management, which I will get into in the future, but that's kind of how it would work when you would take a loss. Keep in mind, you can only lose what you put in. So let's say you buy it for $90, you can only have a full loss of $90 minus 90, right? But if you have correct risk management, you have a stop loss in place, then let's say you would only be risking $20 on that trade, meaning you would be fine with that $90 turning into $70. Now, the last thing that I haven't gone over, which is going to be, let me get rid of these things at the bottom. The last thing which is going to be our expiration. Expiration, I'm just going to put EXP, our expiration dates. Now, what is an expiration date, you may ask? For every option contract that you buy, it has an expiration date. Obviously meaning that it expires by a specific date. Now, when you buy in, there are going to be a variety of expiration dates that you can choose from and trade with. As a day trader myself, I am always trading with the same day expiration dates, meaning that my option contract is going to expire within that same day. Those contracts also tend to be more volatile, meaning they move faster. Keep in mind, certain option contracts will move faster than others, and I will get into that into the next lesson. So, expiration dates. Now, let's say, for example, today is 3/14. Today's Pi Day, right? So, we have our expiration dates. Let's say that I'm trading today and I'm looking to take an option contract. Now, whenever I'm, picking for my expiration date, obviously, like I said, I'm always trading same day expiration dates, but the expiration days go as far as next year. So you can actually hold those option contracts for as long as you want, depending on how you're treating that trade. Is it a swing trade, meaning a trade that you're going to hold into the next day, the next week, etc.? That's what a swing trade is. A day trade is obviously entering and exiting that trade within the same day. That's why I'm always picking the same day expiration dates. Keep that in mind. So just a small thing, but it was the last thing that I needed to go over because it's the main thing that's included within an option contract. When you buy a regular share, there's no expiration date to it. That exit is all relying on you, all relying on your analysis. With an option contract, there is an expiration date, so meaning if your analysis doesn't move in your desired direction by the expiration date, your option contract will be completely closed out and cut, depending on where price is at the end of that expiration date. So let's say that you are in profits, but price, or not price, let's say that you are profiting, but time has reached the end of your expiration date. That contract will just completely close you out, but it will close you out for a profit. And then obviously vice versa for a loss. So that's just another key thing that you need to keep in mind. If you are a day trader, day traders are typically trading with the same day expiration dates or 1 day expiration, meaning the option contract expires the next day. So typically you have a bit more time and room to kind of hold that option contract. Like I said, I'm more of a scalper day trader, so I'm looking to just enter and exit and catch my move and go. That's pretty much going to be it when it comes to options trading. Obviously, you're going to have other certain factors that go into options, such as time decay, Greeks, and stuff like that, which I will get into the future. But realistically, this is going to be the main stuff that you need and just the main information that you're going to want to soak in when it comes to options trading. I hope I was able to best explain everything as best as possible. I will be making various more videos like this, so I hope you guys kind of enjoyed the concept. If you have any recommendations, tips, ideas, whatever the case may be, go ahead and comment and let me know down below. If you guys are interested in one-on-one coaching and working personally with me, there will be a link also down in the description that you can fill out and book a one-on-one call with me so we can kind of see what's going on with your trading and see if you're a good fit to work with me so we can really get you to the next level. Other than that, guys, I will see you in the next video. Much love.